is fiscal sustainability. If the fiscal sustainability of the US is not addressed, why would you invest in a 20-year project? Because the government's incentives are not aligned with you as an investor. You might get higher taxes, you might get higher inflation or some other sort of expropriation. And so all of that investors need to digest. Those buying gold have had these concerns for a while. What we are seeing unfold is that those quote-unquote fringe views of the gold bugs are becoming mainstream. And we are just a few steps into that path. Keep in mind that gold isn't all that liquid when it comes to global financial markets. And so if there's a flight into gold, you can see dramatic volatility as we've seen in recent weeks. And I think that volatility could even get more exacerbated.
Gold has surged past the $3,500 per ounce mark. At the same time, the US dollar index is hovering near a 3-year low, intensifying concerns about the long-term stability and dominance of the dollar as the world's primary reserve currency. Axel Merk, President and Chief Investment Officer at Merk Investments, interprets these developments as more than short-term market fluctuations. He believes they point toward a more profound structural transformation of the global monetary system, with gold positioned squarely at the heart of this evolution. According to Mark, ideas once dismissed as fringe or niche within the gold community are now gaining mainstream traction among investors and policymakers alike. As geopolitical tensions rise and trust in traditional financial institutions wavers, global capital is beginning to seek refuge in assets perceived as more secure and less susceptible to political manipulation. Consequently, safe haven flows are increasingly moving away from U.S. assets, raising fresh questions about the future role of the dollar, the independence of the Federal Reserve, and the broader trajectory of global capital markets. A striking example of this shift can be seen in the actions of China's central bank. In March alone, the People's Bank of China added another 5 tons of gold to its reserves, marking the 5th straight month of gold accumulation. This brings its total holdings to a record 2,292 tons, now representing approximately 6.5% of China's official reserve assets. This signals a clear strategic pivot for many analysts, away from over-reliance on U.S. treasuries. From Merck's perspective, countries less geopolitically aligned with the United States are increasingly reluctant to maintain significant exposures to dollar-denominated assets. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
2 things to watch in the most recent environment. One is gold, kind of the canary in the gold mines, and the other one, you mentioned inflation earlier, long-term inflation expectations. I'll get to that in a second. With regard to the price of gold, let's keep in mind, I sometimes call gold the most direct indicator of the mania of our policymakers. I'm not trying to be critical with anybody personally, but gold, because it has less industrial use than other assets, and because the market, it's not that huge compared to other markets, you see it has a greater sensitivity to things that are happening. And one of the things is that when you have the deficit more financed more domestically, of course, the right thing would be, hey, let's get the trade deficit in order, and let's make sure that that we're not going to have a deficit anymore. But instead, there is a fear that there's going to be more pressure on the financial system on lower rates, and that's partly what you're alluding to with pressure on the Federal Reserve. The one thing I like to point out is we have not seen any retail frenzy in this. What we have seen is in the markets more broadly, we have mostly seen a deleveraging. We haven't seen a panic on the equity side, and similarly on the gold side, we haven't seen panic buying. This has all been extraordinarily ordinary or normal, right? We haven't seen any disruptions, and you would see, I mean, at Kitco, you would see it if the premiums were to shoot up of coins that people get. That means that people are really scrambling to get the coins. There hasn't been anything out of the ordinary in that sense. Clearly, the significant moves are noteworthy, but let's keep in mind, right? The market doesn't price in the future. The market prices in expectations, discounted expectations of the future, and rational people will have different views, and every tweet will change the dynamics. What we do know, to just put that out as a baseline, we do know Trump is serious about balancing trade. He has had that theme since the 80s. To me, that means that these 10% base tariffs are going to be in effect. Everything else is negotiable, but that in itself will have profound impacts for the plumbing of the financial system. And indeed, it will cause an economic slowdown. And I think the price of gold is reflecting many of these things. And that's part of the reason why the price of gold is moving higher. Businesses will always try to sell to us. Consumers, they will find ways, but governments have a choice. Now, one way to think about it is foreign governments, especially those not friendly with the US, are disincentivized to hold US dollar assets. Now, it's not in their interest to dump all the dollar holdings, but on the margin, future allocations might be different, and gold is one of the beneficiaries in that process. So that's the framework through which I look at this. But even the Europeans, they don't want to be caught in that same situation again that they have been in recent weeks. No, the Europeans don't buy a lot of US treasuries, but it will have an impact on asset allocations. But this decoupling from the dollar as reserve currency goes back to this earlier theme of the US being a hedge fund. Hedge fund may be a bad name. Let's use the word bank. The US is the world's bank. There is disruption in these flows and less of a trust. Then there will be more local financing. People always argue, hey, there's no alternative. That's absolutely correct, but that doesn't mean there has to be an alternative. The global financial system pays out significantly. The cost of doing business is going up. The world is a more expensive place to operate in. We haven't even talked about the massive spending the Europeans are going to do. All of that creates inefficiencies, and to all of this, I think, are all valid reasons why some investors are buying gold. The one argument against it is that it might be too much of a good thing, and at some point the price will. Financial markets are so huge that these changes don't happen overnight. I talked about the marginal changes in the allocations for reserves in China and whatnot. But the reason why the long bond in the US is selling off, in my view, is a clear indication that deficits will need to be financed more domestically. And when one tries to think these things through, it's not happening. Trump is furious, is tweeting up a storm. And the question is, what sort of pressure will be applied in the medium term? My own view is that this implicit pressure will, at the end, cause the Federal Reserve to have a bias towards lower rates. And then on the financial flow side, that is far more important for the dollar as a reserve currency, increase also the political pressure dramatically. At some point, if you think about it from a long-term investor's point of view that wants to reindustrialize the US, there's a carrot and a stick approach, is fiscal sustainability. If the fiscal sustainability of the US is not addressed, why would you invest in a 20-year project? Because the government's incentives are not aligned with yours as an investor. You might get higher taxes, you might get higher inflation or some other sort of expropriation. And so all of that investors need to digest. Those buying gold have had these concerns a few steps into that path. Keep in mind that gold isn't all that liquid when it comes to global financial markets. And so if there's a flight into gold, you can see dramatic volatility as we have seen in recent weeks. And I think that volatility could even get more exacerbated.
Each year, approximately 3,000 tons of gold are mined globally, with China leading global production in 2024, followed closely by Russia, Canada, and the United States. Meanwhile, the Bank of England is home to one of the largest known gold reserves in the world, holding an estimated 400,000 gold bars in its vaults, assets worth billions of pounds. As gold prices continue its upward trajectory, institutional sentiment toward the precious metal is increasingly bullish. Reflecting this shift in outlook, Goldman Sachs recently updated its gold price forecast. In a new report, the investment bank predicts that gold could climb to $3,700 per ounce in 2025, with the potential to reach as high as $4,000 by mid-next year. If gold hits $4,000 as forecasted, would you consider buying, holding, or selling? Join the conversation. Share your thoughts in the comments. Give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.